All right, so welcome to part one of our five-part series on minerals in 2020. Thank you for joining us and listening in. Thank you for partnering with Enverus through this time. General disclosure slide, and then some admin notes. So please write down the number of the slide that you have a question on to make it easier for our team. If you have a question during the presentation, feel free to chat them in, and we're going to be answering all of them after the webinar inside of a follow-up. The most common question is generally around whether or not we make the deck public. We kind of leave that up to your account representatives, but all you really need to do is just reach out to them and ask, and then we can kind of get you the information that you need, directly coming out of the presentation. So welcome again. For those that do not know me or have not joined one of my webinars before, my name is Phillip Dunning. I work on our corporate strategy team, focusing on acquisitions and integrations. So those that have been partners with Enverus for a while know that we're a pretty busy M&A company. We've had about 12 plus acquisitions over the past few years. But now, unlike many other companies, right, that kind of conduct M&A, I would say that most people have a hard time actually naming all the ones that we've done. And that's actually what we want. It means that we've done our job correctly of integrating them into the solutions for your everyday workflows. Really bringing that value, without adding any complications to your daily work. Now, this series will be comprised of 5 parts. I will be leading part 1 and part 2, so minerals today in 2020, and then the risk and lead generation is going to kind of flow into the tail end of this presentation and then into the next one. I'll be joined by Rob Zimmerman, who worked as an asset manager in the mineral space for the due diligence, James Ruiz, who is the co-founder of Q Engineering for underwriting, and then Jay Snodgrass, who's the VP over at MineralSoft, who will be walking through kind of diligent mineral management as well as the capabilities of using a mineral management platform in the kind of due diligence and then underwriting phase as well. So between the 4 of us, there's been hundreds of millions of dollars put to work inside of our prior lives, whether that was in private equity, mineral management, etc. We've all put our own money to work inside the space at some point in time, and so we're really excited to be sharing our insights and our knowledge with everyone throughout this series. So our agenda for today, it's a packed one, so strap in. We are going to start with a brief look at our updated price curve in the COVID-19 environment. We're then going to be looking at mineral and deal flows over the past year, just kind of understand where we are in the transaction space compared to the upstream market. We're going to move into activity, kind of using some of the courthouse filings we have just to see what's actually happening on the ground so far this year. Moving then into the bulk of the presentation, looking at risk and how to better quantify it. That's really the heart of what we want to discuss today. What I think is on everyone's mind, how to deploy capital or maintain a solid presence with so much turmoil inside the market. And then we're going to do a brief preview into part 2. Now, this will not be exhaustive. None of these presentations really will be. And I'm sure we can't cover everything that everyone wants. So if you want to learn more about the concepts or the insights that we present during any part of this webinar, all we ask is for open communication with the team. We are more than happy to spend time with you discussing what you need help with, whether or not we showed it in here, or you just kind of have that question of, hey, is this possible? I'm sure we have some solution or workaround, generally regardless of the question, but all we need is that open communication as we go forward. All right, COVID-19 and recovery. All right, so over the past few months, we have maintained our price recovery curve over time. The near-term pricing forecast has gone up, but just due to uncertainty in the market, long-term recovery, as we all know, is going to take time. COVID-19 is just going to be here for a while, and as someone who spends most of my time on planes and on the road, I have not been in the air since February. The running joke in our household is that Southwest is pinging us all the time about how far away we are from companion just to get us back on the plane. It's kind of another gut punch, right, as we kind of look into this season. Now, the decline in oil production has also affected associated gas production. And if we have a standard or a cold winter, we will see an increase in gas prices. That's Enverus' standpoint on that. Just really, due to the lower associated gas coming, kind of out of the Permian and some of these oilier plays. If oil does recover, though, the associated gas can put the stressors on dry gas plays, but that really doesn't seem to be shaping up, kind of as the trend so far this year. So we still think that dry gas regions, are still going to be doing, pretty well. And that's actually been seen, even inside the rig market as one of our indicators. So, dry gas plays have almost doubled their market share in terms of total rigs running since before COVID-19. So a lot more money is kind of being put into those areas. Now, this recovery is also holistic. When we're talking about pricing, we're not taking into account basin differentials, WTI versus Brent spread, etc. All these things that actually have an effect on what in minerals, right, we would call realized pricing, which is really what matters, right? What are we actually getting on our check? So if we think about it, after all is said and done, what price am I getting paid on average as an amount and a percentage, right, of that gross pay, right? How does this differ by state, county, operator in my portfolio? How do I not only find the trends, but use them inside of an acquisition strategy, right, in terms of risk, when we're trying to underwrite? So all these questions will be answered inside, part 2 and part 5 of this webinar series. So Enverus has made strategic acquisitions over the years to allow for owners to better understand what it is they're actually being paid on and how to use that data to make better decisions going forward. Knowing how to risk a deal on that operator's netbacks within a county can make the difference between a great purchase and a mistake. And obviously, as the space is getting more crowded, that is an important differentiator. So as we talk about pricing throughout the series, let's remember that while macro trends will affect wholesale prices, what's going on within your portfolio will answer more questions about the future of what you own and acquire than anything we can tell you, about what's going on inside the world. All right, transactions and deal flow. So mineral deals over the past few years have maintained their high valuations. Now, realize that the price you are paid for a portfolio depends on what we call the portfolio effect. So whoever is acquiring an existing portfolio of assets, right, will determine how it will affect the rest of what they own today. Does it put them at risk of too much in one basin, with one operator, with one play? So the best thing you can do as a buyer, if you are going to try and sell your portfolio down the road, is to understand what those that are buying are looking for. With more mineral companies, right, going public, there is an inherent need for more M&A to maintain growth. Mineral companies, right, they pay a dividend and they maintain it, right, even as the asset declines through these acquisitions. The public companies want to buy both producing and non-producing properties to, one, maintain their dividend and growth, and two, have upside built into their models. So buying 100% PDP is not worthwhile in the long run, nor is 100% of buying PUDs. So with activity down, I really do believe that we'll see many of these companies buying up smaller shops as the lead generation space gets really, really crowded. And it makes more sense on the cost side. Smaller firms are more concentrated in an area. They have better contacts, right, as they're generally the experts inside the region, just meaning that a larger firm should allow smaller teams to acquire assets, which reduces the need for their G&A and increases the margins on the asset itself. Title and land positions are also important. The best portfolios we've seen trade are de-risked by basin, operator, commodity, just meaning that they are not buying one operator's mineral in one county. And then size, right, is also always going to be a problem, especially for multiples. So too small and large, they may not want to acquire. It just depends on the attractiveness of it. Exits are really going to be made, within PE portfolios for smaller entities, and larger public minerals are operators for mid-market. And also, if you have a hedge book, right, that isn't too complicated, and is really de-risking kind of the downside, that is a bonus. And while it can hurt returns, right, inside the short run, its consistency of returns can bolster cash flow, which drives the premium. So being a value stock or a PE fund, right, is worthwhile in the age of fixed income, right? Everyone's trying to find de-risk yields, that won't blow up, kind of like mortgage-backed securities and REITs. And we think that, minerals has kind of been that space for a lot of people. So creative deal financing is hard. So the historical relationship, of mineral owners and operators, is kind of generally described above. However, we know that in reality, relationships are pretty docile. Communication is what remains poor. Most mineral buyers and owners rarely do communicate with the operator that they own under, and opening up a dialogue can't hurt anything. So trying to understand why an operator might not be drilling a permit, or if there are issues with a well like shut-ins, casing, etc., trying to find common ground is important as operators look for ways to make more attractive returns in today's commodity price environment. And most deals are done by relationship, right? So how is your relationship with your operators? So as we talk about creative deal structures, they come in all shapes and sizes. Most are PE deals that are massed in the mineral space, but nonetheless can be deployed by many mid-sized mineral shops. So one operator such as Range Resources have kind of taken a hold of the idea of selling overrides for capital to drill today. Canada, their Canadian operators have done this for a long time. This really hadn't taken off inside the U.S. Until kind of Range pushed it forward. And this allows a mineral shop to deploy capital while guaranteeing that drilling occurs. So it's more about careful modeling of returns and hurdles, to make the structure work. But it is better than waiting on an operator to get financing, that really doesn't exist today inside the market. So the second one with Raised and Diversified, they went a completely different route that, again, has been tried to be used in the past. Chesapeake tried, but they're really the first ones to kind of bring it back up. And what they do is that they take the portfolio of cash flows that they have in-house and then securitize them. So they're giving fixed income traders a package that yields a flat percentage while providing capital to redeploy. So it's a great method for generating cash flow today if the terms are right. It's something that mid-sized mineral shops can look at doing, especially when financing is difficult to come by or debt is really expensive. And compared to debt, the security is generally no recourse. Now sometimes it can be, but it's because it's backed by the asset itself. And again, you can look specifically on Diversified's website if you want to see how they did it as an operator. Raises was private, so it's a little bit more difficult to get information on. But again, it's one of those great uses of a different type of capital structure that we just have not seen inside the market yet, in order to try to get some cheaper methods of debt to redeploy capital. And then for mineral shops of size and scale, you can always go down the road that Blackstone did with royalty relief for drilling today. Again, this is for larger shops that have the sway and the blocky acreage to make a deal like this work. However, there are plenty of instances where mid-sized or even smaller owners can pool together to provide enough relief to get a unit drilled. What it really depends on, though, is the communication with your operator, and it's kind of about your cost to hold. Do you really need that asset drilled today, or are you okay to continue paying whatever cost you have and wait for prices to recover? So at the end of the day, what we're trying to say is that the mineral owner has more power than they believe over the future of the activity on their assets. So with royalty rates close to 25%, they are a real drag on an operator's bottom line. That they will talk to you about some of these structures, and understand that the worst someone can say to you is no. So lots of diligence has to be done to even propose a creative deal structure. But all the information is in your hands, right, with your Enverus subscription, whether it's production, completions, geology, or even researching what other companies have done inside the past. All right, Texas mineral activity in the first half of 20. So let's take a look at the most active parts of Texas over the first half of 2020. Now, we looked at Texas as it has been the most active basin over the years, but also because the data is readily available through our digital courthouse at Enverus. Now, gas plays such as Appalachia and Haynesville have gained significant market share of drilling activity, as I mentioned before, but mineral activity is just starting to pick up. Obviously, we know that there's a lot of buyers out there, but we mean in terms of the filings we've seen coming through the courthouses. If we look at the counties with the most filings and mineral royalty deeds and overrides, we see that the Permian leads the way, as one would expect, in terms of the total instruments filed. Now, with COVID-19, it's been interesting to see some counties that have had issues with loading documents online, but luckily most Texas counties have an alternative method of getting the data loaded. Weld County is very similar. You can just load those documents directly. On the buy side, we can see that private buyers are leading the way in terms of total instruments filed. However, this does not distinguish total acres bought. So understand that the larger the company, the less deals, they generally do because they're larger in size. So we've laid out kind of the public buyers. Again, we know Fortis isn't public, but they did file their S1 just to show the total number of filings on their end. Now, notice that there are quite a few operators on this list that most may not be used to seeing. So many operators are seeing the buying of minerals as a way to shore up their NRIs, which makes drilling more attractive. So since they know where they want to drill next, they have the lowest cost to hold, meaning that they can pay more upfront to a seller because they know when they are going to drill next. We know that there's been JVs out there before, like with Continental, where they will pay a mineral shop to go out and buy ahead of the bid. However, there are operators that are starting to, kind of spin up their own internal groups, and that puts a little bit of pressure, kind of on this lead generation and buying market, because you're now competing with a company that knows what's about to be drilled next, and can spend a little bit more money. Now, the great thing is that obviously using the courthouse filings, you are able to track those in, near real time, right, as these things are being loaded in. So you could actually see where these operators are kind of picking up some of their minerals. All right, quantifying risk. So risk is the one thing that all businesses try to reduce. So in minerals, risk is seen in a number of different ways. Macro, with pricing trends; the operator, bankruptcy, poor operations, underpayments; location, so geology; netbacks, right, the actual paid amount is your revenue; and then activity. Where will my assets, or when will they be drilled, and what is my cost to carry, right? What is the cost of your G&A and your debt compared to when you see that revenue kind of coming in? So we're going to take a look at a few of these today and more along the way throughout the series. But the most important thing to remember about risk is that each company has its own tolerances and profiles. So what we discuss here today may not be yours, but it doesn't mean that we don't have a solution for it. So again, just constantly hitting on it, but do not hesitate to reach out with problems that you're trying to solve. There are many of us on staff to support your groups in helping to kind of mitigate the risk that you're seeing directly. One of the more complicated things to determine is the economics of a well. So as a mineral buyer, you have to determine both the value of the well and of someone's assets. And both can be complicated at a large scale. Do you use half-cycle economics? How do you look at a company's hedge profile to determine how that will affect their drilling schedule? Where is a company going to be deploying capital this year compared to last? So luckily, Enverus has a culmination of answers to this very broad, right, set of questions, which is economics. All wells have built-in break-evens and NPVs to help you understand the economics of a PDP asset. And you can subsequently look at the remaining recoverables to determine if you're buying an asset still in decline or at steady state. So looking at currently producing wells, one can also determine the break-even of newer permits being filed, by looking at what other most recent wells have been drilled. And I think that's important to distinguish. As a buyer, you have to determine if you're buying a well that is still in its, really rapid couple-year decline, or if you're kind of buying that long-tail market. And each one has a different value with it and different risk. So we can also compare operator trends by county, play, bench, if you're looking at your holistic, kind of investing thesis, by having a quicker way to screen and filter out assets that are at risk of not being drilled or too expensive to continue to operate, that you can lower your risk of spending too much on the wrong asset. And I think deal screening is one of the most common errors we see, spending too much time on something that just does not make sense. And so again, with a quick screen, you can kind of reprioritize your focus, on your teams that are looking out there to buy. Pricing. So at the beginning of the webinar, we discussed pricing as a net back of what we're actually receiving on our check stub. So there are two ways to look at pricing risk: wellhead and netback. Wellhead pricing in Texas is provided from the comptroller and placed within Enverus database. And sometimes it's easy to determine which operators have better contracts or are on pipe compared to trucking just by looking at the wellhead pricing of offset pads. Look at oil, gas, condensate prices right between the operators, the basins, or the counties to kind of determine if there is any inherent risk, even a few dollars, to what you're buying. And so inside that bottom chart on the left, that is the disposition data. So what I was looking at is the count of leases for a specific county that are either being trucked or piped. Why? Because if an operator has most of their wells on truck, you are going to have high transportation costs. If it's on pipe, it's going to be lower. That is a risk you need to understand, because that can affect many dollars per barrel that's flowing. So the chart to the top is looking at Williston netback prices for a specific month. What's interesting about this is that you can see just within a county itself, there's a lot of variability on netback. This is due to trucking, due to pipe, due to other post-production charges. That's important, because if you're a buyer of any size and you have multiple operators, it's good to know which one's paying you the most, and on average, because obviously that's going to make a difference when you're underwriting a deal. To know what it is you are expecting to receive back. If you're getting $5 less in today's price environment, that could be upwards of 20%. And so, these things used to be a lot more complicated in the past to be able to get the answer on, because we're manually looking at checks that we're entering into a statement or into a system. Luckily, flowing out of our business automation group, right, all this stuff is automated as a pipeline directly into platforms like MineralSoft that, again, I pulled out into Excel, and are just able to very quickly just kind of screen and to understand where it is I think I'm going to be getting that highest net back just for that risk profile. So understand that the costs of not understanding the net back pricing, right, can be detrimental, really, in today's environment. So we've heard people state that it's only a couple of percentage points. Well, over the life of a well and your placement of capital, that couple of percentage points can add up to a lot of money. It can even determine whether you meet your return threshold, right, from your investors or your own goals that you've set. So in 2020, there really is no reason to not be on top of expenses and netback pricing, just to better determine an asset's value within a single solution. So for engineers and asset teams, you don't have to understand the ins and outs of your check stub to know that having the most accurate pricing possible, will allow for better recommendations during underwriting, which we'll talk about more in detail in part 4 with James. Ducts, shut-ins, and new drills. So the age of what will come online first. We did a webinar just as COVID was kicking off about the risk of shutting in shale wells. And since then, there have been a lot of technical journals and posts about the risk of what happens when we turn on and off the tap. And why don't we really be honest with ourselves? We simply do not know. Some wells are going to be fine, others are not. I look at it at the most basic level of engineering and geomechanics. Dry gas will remain pressured and should flow back with no problem because there's no fluid. Wet gas might have some liquid loading issues in the hole depending on how old it is, or the wetting of the reservoir, which produces some production issues. And oil, especially those with water production, may have problems of production. I would not want to swab a horizontal well to get ahead of water loading. And I saw that in the news over the last couple of days, Continental was bringing online wells that were coming online twice as strong as they were shut in. Well, that's called near wellbore production, right? So kind of some simple engineering principles is that when you shut something in, the pressure builds up. Well, when you turn it on, you're going to get a flush production. That doesn't mean that's what the well is going to continue to produce. You may see a drawdown of pressure extremely quickly. So again, we just don't know. Just be a little bit leery of those. Hey, we turn this back on and it's looking great. It's going to take some time for us to really know what's going on. So new drills are also at risk. If a company has a large inventory of ducts on a single pad, they have a lower cost to bring those wells online first. A duct with at least a cemented liner, right, but hopefully cemented casing, should have no problem being completed without much issue. And really gone are the days of open hole completion where ducts went to die. If a company's having cash flow issue, these ducts are also much cheaper, than a new drill to build up production. We kind of joke and call that quarter cycle, right? Because you've already sunk half the cost. So understanding that many companies are trying to make it through on the production that they have, or just to maintain it at the lowest cost while pricing recovers. This means that a significant reduction in wells being drilled and completed over the next 24 months. And there really is no reason to destroy the value tied up in the rock if you can meet your debt payments, your G&A intact, and maintain cash flow, and just wait it out. The companies, right, that need to drill and complete will be those with a high base decline or larger payments that need to be made, so very indebted companies. And you can track that base decline of an operator versus their needed production to maintain solvency using our PRISM system, or just looking at our intelligence pieces, because it gives a really good indication of what we think somebody actually has to bring online to maintain at least paying their bills. Ducts are also a benefit to buy under because owners are not seeing any revenue. So using Landtrack units, right, you can determine a pad, that has ducts on them that are in steady state production, i.e. you're not going to see a significant drop in revenue from PDP, and there's upside built in because the ducts are already drilled. I like to find units with wells at least 2 years old that have upside in terms of ducts and PUDs already built in. And then using Landtrack lease in a pivot table, using Landtrack units in a pivot table, we can determine the optimal number of wells and high grade those that we might want to buy under first. Now I'm going to talk about that a lot more inside the next webinar, but I did include a table at the bottom of this slide, and what it's trying to say is unit name, number of producing wells, so number of APIs, the max acres or the acres of that unit, my spacing assumption, and then the number of PUDs based upon a very simplistic spacing. So all that it's trying to say is one well online, a 640 acre unit at some specified spacing. I think there's 4 ducks. Well, that's great, right? That kind of gives me my high grading of of upside potential. And on the right, I'm just showing an image of a unit right now that has multiple ducks sitting on it in one producing well. So that one producing well is holding the acreage. It's got 2 ducts. That's some good upside to buy underneath. Again, the mineral owner generally does not know that these wells are waiting to be turned on. They only see the checks that are coming in. Gives you a little bit more opportunity to kind of buy at a little bit of a lower cost. So new drills will still happen, but the question is where. So ducks, right, have already sunk cost in terms of trying to bring them online, and new drills need much higher pricing really to break even. So using the break even for wells within Prism, right, we can determine which areas of an operator's positions are more likely to be drilled if they are running rigs at all. And then using Broadcast and Intelligence, we can track the number of spuds a company is saying that they will be bringing online during the year. So then tie the two together. You now have a more accurate understanding of where drilling can take place and a company's focus on drilling new wells. So where makes the most sense in terms of break-evens, and where has the company actually said that they're putting dollars to work and how much money to work. Now, one new feature we're starting to let clients know about is activity tracking. So using satellites and other data that's been used in the past to track consumer spending, we are determining the activity on a well site to determine when a pad is being constructed, drilled, completions workover, etc. in the future, and it ties together with our daily rig information, and you can be ahead of the bit, for new drills and completions and other events that happen. Now, we're going to discuss this more inside the next webinar and a little bit later inside this one as well, but it's just something we want to be putting some more focus on, on the capabilities that we're investing in right now to help you stay ahead, of the curve.
Cycle times. This was one of the hottest methods we saw companies using to determine how close they can buy to the bit or pre-royalty payment. Now, very few of these data points are valid. Permit filing has slowed down in COVID-19, which throws off percent drilled calculations, which leads to less speculation or arbitrage opportunities, just because less permits are being filed, so there's a higher chances of the ones that are filed being drilled. The duct count is growing, which we showed on the last slide, which means that older ducts are not being completed, so permit to completion times are thrown off, and subsequently completion to first prod and then first payment. So the important part of cycle times is the efficiency of an operator. So less of a de-risking tool on when is my first check and more of a de-risking of the total times it takes to get a well to production. So faster completion to production times, means quicker returns, longer spud to completion, means a duct build, etc. So these efficiency metrics can bolster your NPVs and IRRs as you can better determine when a well, after a completion filing, will actually be brought on. 6 months of additional, lead time to receive your first check creates, an adjustment of returns. So accuracy in the underwriting is really key, to more accurate returns, and so cycle times can be used to really determine, how long some of these specific activities can take depending on the basin, the county, or the operator.
So when we're talking about moving the industry forward, oftentimes we think of grand things, remote operation centers, remote drilling, etc. What about the radical changes in the small things? So activity tracking via Enverus has changed a lot over the last 20 years, and we're really not done yet. It started with a simple idea of putting a permit on a map, before things like even Google Maps, which was 5 years after Drilling Info started, came about. We then moved on to GPS units on the rigs to track daily rig activity, helping to shore up what is being drilled, actual ducks, days, weeks, and even months sometimes right before the state would be releasing that data out to the public. And that started, around the 2015 timeframe. And with activity tracking, we are moving into a new era. So we're utilizing techniques that hedge funds have used to track shopping activity on Black Friday, and companies like Google use to create traffic patterns, and we're combining this with the regulatory data that we already have internally, the rig movements we have from the GPS, satellite imagery, machine learning, and then signal analytics. And that's determining where and when wells are having more activity. So we're in the early phases of this step change and staying ahead of the bit. So imagine being able to track pre-spud activity, pre-completion activity, workovers, etc. In a low price environment, knowing what wells are being completed is more important than knowing where the rig is. To be honest, because again, things have to things are going to be brought online, but not at the same pace that they were prior. So going forward, right, it's going to allow for that capital to be placed more efficiently, which should be yielding greater returns for everyone. So COVID-19, has put many other companies on their heels, but at Enverus, we are definitely leaning in, looking at the struggles you guys are facing over the coming months and years, and then trying to build these tools and insights to help you make those decisions. So we're excited on this step change. Again, when you're inside of our new Prism platform, you can hop in there. You can start to see some of the changes over time that we're going to be making to this activity tracking, and then always give us feedback if you want to on it as well. So a bit of a preview in the next time. We'll be focusing on lead generation using various Enverus tools, including some of the applications. I'll be joining again to help navigate the world of the Enverus solutions. If you have any questions, please type them in. We'll be following up with you. If you want to learn more or have feedback on what you saw, please reach out to your account rep. And we just want to appreciate, or just say thank you, and that we appreciate you guys being here today and partnering with us, during this time. So looking forward to talking with everybody next week. Have a great day, and let us know if there's anything we can do to help.